your estate to real estate. It's Money Matters with Dino.
I want to bring up this dealer or flipper mentality that's been happening a lot since the big crash. There's been a lot of people out there making good money, but from the conversation you and I had, and this is stuff I wasn't even aware of, which kind of took me by surprise being in the business. I thought I would have known about it, but you're saying that the IRS is looking at these people differently, and they're going to be, if they're considered a dealer, right, that the tax implications on them is significant. Can you explain a little bit about that?
The big thing we're always talking to clients about is dealer versus investor. And which one would you rather be? You'd rather be an investor because holding a property long term gets you capital gains treatment, which is a lot lower than ordinary income tax rates. Being a dealer, when you sell a property, all of it is ordinary income, taxed at the highest rates possible.
And I know it's different for people, but just kind of if there is a average number, what is short-term capital gains versus long-term? Short-term
capital gains is ordinary income.
And that depends on your tax bracket,
and
right?
your tax bracket is 39.6. Plus you could be subject to the extra new 3.8% net investment tax. So it could make it substantially in the 40s. People are like, oh my God. And then throw in the state of California tax, and you could be actually paying over 50%. So the tax rate for ordinary income gets up there.
And what does it drop to when it goes to long-term?
Long-term, it's 20% maximum federal.
And that's 12 months, 1 day.
12 months, 1 day. Now, a lot of people ask, what's the capital gains rate for California? I always try to point it out to everybody. There is no such thing as capital gains for California. The state looks at all income the same.